everyone, and welcome to the Economics in Action podcast. In this episode, we'll be exploring the notion of a trade deficit. You may have already had some common questions when hearing about this topic. Are trade deficits bad? Do countries that export more do better than those that don't? Why has America had a trade deficit for so long? We'll answer all these questions and more in this episode, but first we need to talk about the balance of payments. In simple terms, a country's balance of payments is a record of the economic transactions of a country with the rest of the world. It tracks the money flowing in and out of the country. This includes things like exports and imports of goods and services, money earned from investments abroad, and more. Still with me? Okay, let's break it down more. We can think of the balance of payments as having two main parts: the current account being one half or side of the ledger, and the capital or financial accounts being the other. The current account captures the net flow of money that results from engaging in international trade, while the combined capital and financial accounts capture net change in ownership of assets and liabilities. In more plain English, the current accounts track the flow of money from trade in goods and services, like exports and imports, income earned from abroad, such as wages and profits, and unilateral transfers, like foreign aid or money sent by individuals to their families in the country. Because trade in goods and services make up the majority of transactions in this account, that's why when some people talk of a trade deficit, they are referring to a current account deficit. The other part of the balance of payments, the capital and financial account, is often just called the capital account to make things easier. The bulk of this part focuses on financial transactions, including investments, loans, and changes in ownership of financial assets like stocks and bonds. I think it's easiest to view this in terms of something we already understand, which is trade between two people. For example, if I grow vegetables and then sell them at the farmer's market and you buy them, we have engaged in an economic transaction where real goods have been exchanged, the vegetables. This would be recorded in the current account section of our own personal balance of payments accounts. If the buyer sold me something, like candles, of an equal value, then our current account transactions would offset each other. They would balance. If the buyer doesn't have anything to sell me in return, then to pay for the vegetables, he might just have to give me money, a financial asset, or I might have to offer him a loan, also a financial asset. This would go in the capital side of the account because here goods are exchanged for financial assets. The main point is that the value of the vegetables, let's say they were $10, and the value of the loan, $10, are equal. Therefore, the balance of payments is always balanced, meaning that the money flowing into a country is equal to the money flowing out. If there is a surplus in one part of the balance of payments, like the current account, it is balanced by a deficit in another, like the financial account. We can think about one more example. When a shipment of soybeans is exported from America to an overseas buyer, a credit entry will be made in the balance of payments reflecting the value of the shipment that has been provided to the overseas buyer. On the other side of the transaction, the American seller receives a payment for the soybean shipment, and this payment is recorded as the offsetting debit entry. Since every transaction in the balance of payments has two offsetting entries, the total balance of payment should be zero. The point of explaining all this is to say that when countries make economic exchanges, something is always bought and something is always sold. It would be great if countries would just give us things like toys, stereos, and cars, but unfortunately, they don't. To trade with another country, you must sell them something. And in the case of countries with a trade deficit, the thing they sell are financial assets. These are either pieces of paper saying I owe you money in the future, stock or ownership in businesses, or in the case of direct investment, investing in the building of new businesses. Before we talk about whether this is a good or bad thing to have a trade deficit, It should be mentioned that, in theory, trade deficits shouldn't last for a long time. This was the insight of the 18th century Scottish philosopher David Hume. He realized that trade imbalances shouldn't last for long, because if a country is exporting more goods to another country, that would mean more money, gold in that time, would be flowing in. When the amount of money or gold increases relative to the amount of goods in that country, the prices will go up, thereby making the goods in that country more expensive. This would result in the importing country buying less of that country's goods because the price had risen. This self-correcting mechanism, called the price-specie flow mechanism, specie meaning money, also applies today. When the US runs a trade deficit with China, that means Americans are buying more Chinese goods than Chinese are buying our goods. Americans are selling dollars and demanding more Chinese currency. That should push the value of the dollar down because people are selling the dollar, and push the Chinese currency value up since it's in high demand. And yet, the US has run a persistent trade deficit since the 1970s. So what's going on here? Well, firstly, the US has had low levels of national savings that began decelerating in the 1980s. That means that private savings from households, as well as government savings, or the amount the government has left over from tax revenue after it spends money, have both been low. Next, the US is special because the dollar is a global currency reserve. People all around the world use the US dollar to trade goods and services, even between each other, without the involvement of the US. Therefore, the dollar is always in demand, and these market forces keep its value high. In addition, the US has another financial asset that everyone in the world wants: US Treasuries. These IOUs from the US Treasury are in high demand globally as a safe asset to buy for saving. The strength of the US economy and its vast financial system make buying treasuries a go-to place to store wealth, which also pushes up the value of the dollar. Finally, some countries like China, who don't have enough domestic demand and want to grow by exporting many items, will intervene in currency markets to keep their currency at a lower value to attract people to buying their products. They do this by selling a lot of Chinese currency in the open market and buying up US dollars. However, even if a country is running a persistent trade deficit, is this such a bad thing? Former Fed Governor Alan Binder once said this about trade deficits: "They're absolutely normal components of trade. I now have a very large bilateral trade surplus with my employer, Princeton University, which gives me a paycheck, and I buy almost nothing from the university. I have a bilateral deficit from the grocery store, where I buy lots of food and they buy nothing from me. That's the way trade goes." End quote. So, are there any harms to America buying more foreign goods and selling more of its financial assets? Well, just like everything in economics, there are always trade-offs. One of the clearest positives of running a trade deficit is that as a country we're consuming more than we produce. Not only that, but we are importing products at low prices. When countries open up to trade, the whole world becomes your market. Businesses can look for the lowest wage countries to produce in, and consumers can buy things they want from that country. For example, one of the reasons why we can go to Walmart and buy products for such cheap prices is that they were produced abroad where incomes are lower and labor resources are much more abundant, like in China. We also get a wider range of goods from a variety of countries, which can increase consumer welfare. Another benefit for the US is that since demand is incredibly strong for one of our most sought-after export services, namely financial assets such as treasuries, we can sell these assets at low prices, meaning that we can borrow from the rest of the world without paying high interest rates. Not only that, some countries use up those extra dollars we give them in exchange for their goods to invest in the US by setting up factories or businesses, hiring workers, and purchasing things like machinery. This can give a boost to the economy and lead to greater output. Now let's talk about some of the downsides. One concern of some economists are the large fiscal deficits that are often accompanied by trade deficits. This is known as the twin deficit hypothesis, which says that governments who spend more money than they take in tax revenue will lead to a country that has a current account or trade deficit. As we mentioned earlier, the US sustains its trade deficit by borrowing, and as we also said, borrowing is cheap. However, there is worry among some economists that if the borrowing piles up and becomes too large, leading to an unsustainable amount of government debt, other countries might stop investing and lending to the US, which would lead to higher interest rates and a decrease in the value of the dollar. If this happened too quickly, it could lead to a recession. However, while this scenario is a possibility, there is a lot of disagreement about how likely it is that this would occur. In line with this, some worry that because trade deficits come with foreigners investing in and owning assets of a country, such as the US, this could pose risks. Another downside of the trade deficit and trade in general is the effects it has on labor markets. Many blame the gutting of the US domestic manufacturing sector on the shift of production to China in the 1980s. Estimates vary as to how much trade has impacted this versus how much of it was due to productivity enhancements due to technology and capital improvements. But there's no doubt that trade can affect workers in some industries and lead to some tough readjustments. Lastly, a big worry recently are supply chain disruptions due to geopolitical rivalry and disagreements with other countries that we depend on for trade. If we import most of our goods from abroad, and some of those countries, China is a recent one, cuts us off from those imports, it can have a large short-term impact on consumers and producers, raising prices and leading to shortages. This is a real issue, especially if there are threats to national security. Increasing investment towards domestic manufacturing or to countries with more friendly relationships is the typical solution. However, most economists agree that these solutions don't come without cost, such as higher prices, slower economic growth, and reduced living standards over time. Hopefully this episode has given you a more nuanced understanding of trade deficits and trade in general. Thanks for listening. Also, if you like this podcast and want to subscribe or leave comments, it would be greatly appreciated.